JSW Steel, that's the one that we're looking at today. Remember, in yesterday's trading session, the numbers came just before close and they appeared in line with what the street was working with. But I expect the stock to come in for some selling today because the fine print didn't look very, very good. Let's run you through the top highlights then. Where was the miss? The sales volume that was lower than estimated. The second factor is that the EBITDA per ton came in at its lowest levels that we've seen since Q1 FY18, and in fact it missed our estimates by close to around 6 to around 700 rupees odd. The foreign subsidiaries, they reported deep losses, so that isn't great news. But in terms of good news, well, they've postponed some capex, which the street will read positively, and also now the management is guiding for better EBITDA per ton in the coming quarters. Let's run you through the details then. Sales volumes, we were working with a number of around 3.7 million tons. It came in at around 3.6 million tons. The management, as expected, or in fact as the street was trying to factor in, they've gone ahead and they've cut their guidance for the coming year. Now they've scaled it down by close to around 3%. That'll be roughly around 500,000 tons odd. We tried to quiz Mr. Rao earlier this month itself, and he said post the results he'll let us know, and they let us know yesterday. Then in fact, in terms of an EBITDA per ton, that's the lowest we've seen since Q1 FY18. Came in at around 6,500 rupees. The street was working with a number of around 7,200, 7,300 rupees at least, so that was a bit of a miss as well. What are the positives then? You know, when you're in trouble or when you're running a marathon and you're getting a little tired, you don't want to take more stress on yourself. So in this sort of environment, JSW Steel have gone ahead and they've scaled back their capex by 4,700 crores. From around 15,700 crores, it's come down to around 11,000 crores, which is good news. The second factor is, in fact, the EBITDA per ton. They believe that it's bottomed out. So they were buying coking coal in the past quarter for around $180 per ton. Now, in fact, those prices have come down to around $150 per ton. So lower raw material cost and stability in prices will help the EBITDA per ton going ahead. And as expected, the first half of the year, EBITDA per ton is much lower than what the street was working with. So brokerages, they have gone ahead and they've cut their estimates.